and welcome to the second in a series of webinars held by DeVere Group in China. So we're starting at 7 o'clock. We may have a few more join us as we go along. So we're here in Shanghai. We've been here in Shanghai office all month, actually. Given the current situation, we're obviously reaching out to other expats just like us who are here in China, but also around the world, whether it be in Asia, whether it be back in Europe or elsewhere. So we're reaching out to you via these webinars to give you information, to make sure that we're updating you on what's going on in the world, and to make sure that you're in the know and that you're not in the darkness, even though a lot of us are feeling a bit lonely, perhaps quarantined back at home. So, as you may know, we help our clients grow their wealth. We do that in a variety of different ways. And today we're focusing on international property, and specifically the UK. So as a company, we are very positive on the UK property markets. And basically what we want to be doing today is presenting that and allowing Frank Cartwright from API Global to present everything about the UK and what we think about it and why we're positive about it. But we don't just focus on the UK. We have a lot of different investment properties around the world in various different international hotspots. So what I'll be doing at the end of this webinar is I'll tell you how you can actually get in touch with us and how you can find out more, both about the UK, but also about other international markets that we're able to offer our clients. So do hang around for that, and I'll make sure I give you those details. But as I said, the main objective today is to talk about the UK. So Frank will be going through a presentation about this company, about what the UK has got in store for us. But what he will also be doing, very kindly, is he'll be allowing us 10 to 15 minutes towards the end to ask any question you like. And I will be making sure that he answers your questions very accurately. So what you may be able to see, if you haven't used Zoom before, is down the bottom probably there'll be a Q&A button. So if you click on that, or there's also a chat option as well. Both of them you can use. So type in your question either at the end while it's going on. If something pops into your head, put the question in that box and I'll ask it to Frank at the end. Okay, and with that, I'll hand over to you, Frank.
Thank you, Will. Hi, everybody. Thank you for sparing a few moments this afternoon. And thank you for, if you did donate, I know it's a very good cause and something, if we are based in China, we can get behind. But without further ado, I'll basically introduce myself quickly. So I'm Frank Cartwright. I look after the Asia operation as part of a company called API Global. Now, we're essentially a research company. We tend to follow demographic trends, specifically in the UK, and how those demographic trends ultimately will affect real estate prices, whether negative or positive. Now, what we do know in the research entity is that the biggest driver of real estate basically tends to follow a formula. And this formula can be extrapolated across any international market. Now, the key thing behind all of these types of formulas is the one thing driving real estate prices is government fiscal policy. And what I mean by that is the government investing in the area of land or the parcel or the part of the country where you're looking to invest in real estate? We know that government fiscal policy brings with it infrastructure projects, educational numbers, economic institution relocation, larger infrastructure projects such as train lines, airports, and secondly, is the government going to regenerate that area as part of that kind of service? So what we do is we look at the UK as a whole. Over the last 10 to 15 years in business, we've looked at 5 or 6 different international markets. Tends to be Western democracies because we like, first and foremost, the rules and the regulations, the judiciary systems of Western democracies, but we'll look at America, Australia. But where we like to focus is, can our clients and can our investors get mortgage financing? And we know that international banks are very, very, very positive on the UK. So once we've looked at a macro scale where we think we're going to be investing, we then will look on a micro scale in terms of a specific city. And we'll look at 50, 60 different developers in a specific city. And then we'll go in and underwrite a project. Now that what means is we're basically physically putting our cash into basically securing 25 to 50 exclusive units within a development. They're ring fenced and then given out across 50 different offices through DeVere. So we can approach any developer in the market and say, look, we've got over 100,000 clients, $10 billion under assets. We're underwriting this amount of units, and it's going to be exclusively ring-fenced for De Vere clients. And we finally underpin all of that with an elite property service with a UK-based solicitor, a mortgage desk, and a lettings and management company to look after it for you when the apartment completes. And then also De Vere Tax and De Vere FX to basically manage every single aspect that you would think would be a turbulent part of investing overseas, if you're based, in China or wherever you may be. So first of all, I'll come into the first slide, which is basically a JP Morgan analysis on UK property returns versus macro hedge fund returns over the last 20 years or so. Now, on the left-hand side, you can see on average UK property returns in light blue capital appreciation and in dark grey income. Now, what we know is, there's two ways of growing our wealth through real estate. Exactly that, income and capital appreciation. Now, income, otherwise known as your yield, is what your tenant is paying you every month to rent that apartment. Now, on a good year or on a pretty average year, we know that we can get about a 6-7% yield dependent on what we purchase the apartment. Now, you'll see in the light blue the cyclical nature of real estate in terms of where we've seen growth, where we've seen volatile growth, and where we've seen corrections. Now, we've always had a stable income when we've had a correction, because we know in times of uncertainty and any times of kind of political uncertainty, home ownership and buyer sentiment goes down. More people tend to let properties than live in them. So even if you're buying a property in, say, 2002, you see great capital appreciation in that property and the market tanks, you're still paying off that mortgage through the income generated in the apartment. And this is just one of the things that we have as a basic safeguard to show you the volatility isn't affected in only one kind of avenue of income. Now, why do we focus on the UK first and foremost? Well, as with any asset class, the main driver of price is lack of supply and increased demand. Now, we know that the UK in any kind of Western democracy is the most chronically undersupplied property market anywhere in the world. Each year, the government has said that we need to build on average 240,000 new homes to keep up with demand. Now, as you can see in the last 4 years, we're well below that evaluation, and it comes out on average about 50% shortfall every year of properties brought to market relative to properties needed in the market. Now, what this does on a supply and demand basis is, if you can see average property values from the 1980s forward to 2012. Now, the UK in 1950, the average value of a property was £3,500. Fast forward to 2019, the average value is around £225,000, and that's singularly dictated by supply and demand. Now, we know real estate is cyclical in nature, and we know that real estate in the UK tends to double every 12 years and has done since World War II. But of course, geographically, that depends where you are. Now, London is completely separate from the Northwest, which is completely separate from the Northeast. It is very much like microclimate investment, and it all depends where you are in the cycle. And I'll come back to what a cycle is, but where you're investing in a cycle, specifically in real estate, is probably the most important thing. Now, this is taken from the UK Land Registry, which is a government data meta-analysis of all UK housing transactions. So you can see from 2015, we're averaging about 4.5% growth per annum across the whole spectrum of the UK. Now, let's not forget that we just talked about dividing it into subsections and how geographically everything is different. But on a whole, the UK grew about 22.9% since 2015, which is pretty stable considering all of the political turmoil that's been going on since Brexit. Now, if we look at the average prices in London, so 2015, we saw great capital appreciation, but it has leveled out since the Brexit vote from 2016, but still strong capital appreciation of 3.7 per annum. Now, this is one of the areas that we're targeting, Manchester. Now, you'll see the difference singularly in the capital value of what we're starting at here. £400,000 on average is the starting price in London, whereas our starting price on average in Manchester is 134,000. So when we talk about cycles, if you'd have bought a property in 2008 after the financial crisis in Manchester, the relative growth over that 6-year period was relatively nothing. Whereas being from 2015 to 2019 has been astronomical in terms of growth, singularly because of where we are in a cycle and how much growth there is left in those apartments in terms of its value. Now, this is because of what is known as the Northern Powerhouse. Now, I'm sure most people have heard what the Northern Powerhouse is, but how it really takes effect is building what's called a knowledge economy. Now, in the 1990s, the UK went through a whole transformation in terms of its economy. It went from basically a manufacturing economy into a knowledge-based, service-based economy. Now, Manchester is now home to the BBC, ITV, Facebook, Microsoft, Amazon, Booking.com, key knowledge quarter, kind of companies which can attract talent from universities and really bring natural living wage up to a standard which can be comparable with London. If we look at a place like Birmingham, we've got 125,000 financial services jobs in Birmingham, HSBC headquarters, RBS, KPMG. The latest news out recently was Goldman Sachs were looking for 60,000 square feet in the city centre. Almost half of its financial technology jobs will now be moved to Birmingham. Now, this is for a host of reasons, but if you look at each of the areas that we target as key educational hubs, operational costs are on average 50% cheaper to have an office in Birmingham and Manchester than it is in London. Now, on average, you have about 75,000 students in both cities, so a real knowledge hub to draw from. Now, with the introduction of something called the HS2, I'll show you further down the line, suddenly these areas become commutable to London. And as I say, we're starting to piggyback government fiscal policy in the terms of infrastructure. So they create and they start to show really interesting investment cases. Here's how Manchester and Birmingham have kind of leveled up against the UK in general and London in light blue. I'll show you in a later slide the growth trajectories moving forward relative from 2015 and where we want to be in 2022, 2024, and where the growth markers are moving. But as you can see, Manchester and Birmingham are trending upwards and are higher than London. Again, just to show you here where we are in a cycle, where we've seen most of our growth has been in London. And if we're looking at extrapolating the light blue from the capital appreciation, we would see that on up to 2022, 2030 to 2025, the light blue would carry on exponentially because of where we are in a cycle. Now, this is our new leader. I'm sure everybody can recognize this individual who is now the Prime Minister of the UK and has been for some time, but what he has done for the market, for the sterling, for the currency, has been crucial in terms of confidence in the UK. Now, for the last 18 months, when we've been positioning UK property as an investment, specifically European, but a lot of people have been skeptical about how the UK will look and how weak the GBP is, and does that have an effect on the FTSE 100? Well, we know from 2019 in August, when his Brexit resolution got shot down in Parliament, the pound was 119 against the dollar. Now we're trending at about 134, 135 against the dollar. Now, savvy investors bought real estate when the pound was low, but this is still exponentially lower than what we were pre-Brexit. And we're going to see confidence rally on the pound as more and more solutions are brought forward in terms of the Brexit negotiations. And if we go, January of this year has seen the highest increase in property values in the UK since we started tracking value. It speaks for itself that confidence really brings about investment. So we can see that, on average, 2% tipped to rise in the north in January alone. We knew that through the Brexit turmoil we've seen from the markets data we showed earlier, 5 and 6% per annum through Brexit. And now we've seen a resolution, we expect that to carry on. So Birmingham in general, since the Brexit vote, the average value in 2015, about £144,000. In 4 years, we've seen the average value increase to £189,000, about 6% per annum. So what's been going on with Birmingham? Well, there was an introduction of something called the Big City Plan. 20 years ago, Birmingham, Manchester, Liverpool, Leeds, all of these regional cities were not especially nice places to live. Most of them were industrial textile places, which were the heart of the manufacturing system. Now, we've said that every city has had to revolutionize itself. This was Birmingham's Big City Plan. As the second city in the UK, it was the main recipient of government spending. So it was launched in 2010, and it was basically brought about to completely transform the economic landscape in Birmingham. So, sorry, that was running over the top. If we look at the infrastructure improvements made in Birmingham, these are some of the financial hubs that have now been added into Birmingham city centre. The New Street station, which 5 years ago was probably one of the worst train stations in Birmingham, is now one of the best. Paradise, which is now home to HSBC, you now have the £1 billion Smithfield regeneration, and all of this now means new jobs, new infrastructure investments, more people living in the city. So this is Paradise, which is basically the city centre heartland, which is showing you basically the redevelopment of what's going on in the city. I'll skip through as we come through, but you can basically see flagship new commercial buildings which are going to be undertaken by huge multinational corporations, one of which is KPMG and PwC. Two huge accountancy firms are now moving their headquarters to city centre Birmingham for the reasons that we spoke about earlier. Now, what we talked about, a knowledge economy, is underpinned by students. So 75,000 students in Birmingham across 4 major universities. But what's interesting is Birmingham has the highest or the second highest student retention rate behind Manchester at 49%. People are choosing to stay, live and work in the areas that they graduate because of the availability of jobs in the city. Now, this is all underpinned by HS2. Now, I'm sure people have heard about the contention about how much it's going to cost. If the Chinese government wants to come in and build it, I know they came out recently and said we could build this in 5 years for 50% of the cost. So what HS2 will do is make Birmingham commutable to London. So at the moment it takes an hour and a half. In 2026, it will take 49 minutes to get from Birmingham to London. For the first time, you can get from Birmingham New Street to London Euston quicker than you can get from Zone 6 and Zone 5 on the city centre outskirts of London. Now, this is huge for a number of reasons, but this is the latest construction update. I'll whiz through this because I've seen the latest data that's been coming out. But here is the excavation being undertaken at Curzon Street Station. So you can see Curzon Street Station there, right in the heart of Birmingham. That's going to be the new connectivity for the HS2. Now, what that does for us in terms of population, so like very much what's happening in America, you're seeing the largest number of millennials move out of core city centers such as Manhattan, Los Angeles, because once you start spending over a third of your rent, of your income on rental income, on your actual, when you start spending more than a third of your income on rental, then you start to find real problems with millennials. Now, the difference being in London as the major city in the UK of 9.2 million, Birmingham being the second with 1.3, is that the average price per square foot in central London is £3,500. The difference for the UK's second city, £400. Now, we're not saying that in 5 years' time, when HS2 is introduced into the city centre, that central Birmingham will be up at £400 per square foot, up at £3,500 per square foot. But all we need is that to tickle from 400, for 425, 450, 475, in line with what we've already seen for the last 4 years in terms of the capital appreciation, to start getting a really good return on investment. Now, we know when that's coupled with leverage, we start to see an even bigger return. So here you can see in light yellow the next expansion to be coming into central Birmingham. Now, a lot of this will be focused in and around a place called Digbeth. Now, Digbeth is very much like the Shoreditch, the East End of London. At the moment, it's basically a millennial stronghold, cafes, bars, restaurants, that kind of essence. But when we're looking at a property and we're looking for rentability, what we want to be doing is we want to be near a commercial entity, so our tenants can walk to work. We want to be near an infrastructure project, so we're near the new HS2, and we want to be in a wider redevelopment zone. So this thing here called Smithfield Market Regeneration. This is a 1.5 billion, one of the single largest projects being built in the UK at the moment, which will generate 300,000 square meters of new commercial space and over 3,000 new jobs. Now, this is going to be in the city centre of Birmingham, but in Digbeth on the south side of the city, where we know we can still access value. As you can see from the slide, our development at the bottom is highlighted in the circle. At the top right, you've got Curzon Street Station, and on the left, you've got Smithfield Market, which is the £1.5 billion regeneration just to the north. Now, we'll come on to the development in just a second, but here it is, Apex Lofts, built by a company called 10M Group. Now, what you'll notice if you are familiar with De Vere property is we singularly start taking positions in small developments. Now, we do this for a number of reasons. One, we know that first and foremost, that actually designing it and building it is a relatively simple process. We're not building a 1,000-unit tower, which is going to be incredibly expensive and delayed over time. We're building an 80-unit building, 10 stories in height. And what this does for us is it keeps our service charges very low over time. So if there are some seasoned professionals in the group tonight, if you have bought a property before, you know the most important thing on a long-term investment case is to have a low service charge. So you have good enough amenities such as the build and finish, such as this, but you need the amenities to be low enough and the building to be, good enough quality that the cost will be low over a 10-year period is what we advocate holding the property for. Everything is high specification design, floor to ceiling high windows, hardwood flooring, very high spec design finish, kitchen whites come as standard. As you can see, good finishing, and we offer the furniture packs as complimentary on completion. Now, some specifics. Completion was Q3 of next year. Starting values at £219,000, about £390 per square foot. Now, it's 20% on exchange, 10% of that which is secured in secure escrow account, and the balance upon completion, in which we will be facilitated by the mortgage. Now, we're working with a company called 10M Group, which are an award-winning developer out of Birmingham. They've completed some of the coolest and most contemporary buildings in and around Birmingham. Number one, it's called Ironworks, which is a hard brick, veneer, kind of high ceiling, exposed brick and wood. And then this is the second one called Hampton Court on the outskirts of Birmingham. As you can see, the finishing is very, very high quality and high standard. Everything is contemporary. The architects that we're using in Birmingham are award-winning also. So we want to have that kind of feeling that's going to really stand out for our target tenants. Now, the main thing that you want to be doing is making sure that you're buying at market value. So we know that if you look at the map here, you'll see the development Westminster Works, Timber Yard, the Axiom, Arden Gate. Now, if you're familiar with the company, we did very well with Arden Gate, which is now becoming fully let. And we'll be looking at launching a project next to Westminster Works, which is the Apex. Now, price per square foot is the most important thing that you're looking at when purchasing an apartment, because you need to know that what you're buying is at market rate, because if you are buying with a mortgage, you need that market rate to actually facilitate the mortgage. Now, we know huge developers such as Seven Capital, Galliard, Berkeley Homes are bringing forward properties in the market at about 456, 439, and £448 per square foot for similar specification developments that we have. Now, these buildings will take 3.5 to 4 years to build because they are these large towers that we said we don't get involved in. We know we're at £390 to £400 per square foot. We're an 18-month build, and we've got what's called first mover status, which means that will be built and will be in the market 1.5 to 2 years prior to any competition. So here's the allocation. As you can see, an average blended price per square foot of £390 to £400. We have a mix of 1, 2, and duplex apartments, which are called skylofts. Usual net area is about 50 square meters for a one bedroom, which are large one bedrooms, to about 70 square meters for 2 bedrooms. And then we have larger duplex skylofts on the top floor, which are about 1,000 square feet. So this is incorrect in terms of its square meterage, but that's 2-floor duplexes on the top floor. So I'll just end here basically on the Apex Lofts. This is one of the developments that we have in Birmingham. If you are interested in the areas that we've spoken to, specifically Manchester or Birmingham, we do have different developments in the area, some fully built, some close to completion, but this is our flagship Apex Lofts. So I'll come to a conclusion there. If anybody does have any questions, please do feel free to ask Will, and then we'll go through some of the analysis and data from the very beginning. Okay, yeah. Thank you.
Yeah, Frank, we've had quite a few questions come in. Thank you so much for that. Are you still with us, Frank? Yeah. Frank, if you want to leave that slide up, and I'll just start going through some of these questions. Just confirm you can hear me, Frank.
Okay, so
yeah, Frank,
we have some questions come in immediately. Okay.
Frank, have you got yours? Frank, hello.
Right, so let's start, if everyone can still hear us here, with the first question.
Hello, Frank, can you hear me now?
Ah, sorry, yes.
Yes, can you hear me now, Frank?
Yeah, sorry, you were muted.
Yeah. No problem, bit of a technical issue there, no problem. Yeah, thank you so much for that. I've got a good order to put them in. So we've had quite a few questions specifically about Birmingham as well. So what I'll do is I'll start on the ones about Birmingham, and then we've had some more sort of UK general questions as well.
Sure.
Okay? Perfect. So one of the ones was around HS2, which you brought up. Do you see, well, I mean, obviously it's now been announced that HS2 should be going ahead. Certainly Boris has given it the green light. Would you see the HS2 having the effect in the Birmingham house prices now? Or is it more likely to bring a bounce around in sort of 2026 when we're expecting it to be completed? Or maybe both? What do you think?
Well, I think that's the main thing that we're looking to do as an investment company, right? Is we want to be investing in an area where we're already pre-value. Now, if we were investing into Birmingham in 2026, we would have already seen huge capital appreciation because of what we've already said that's coming. So it's about investing in areas that we know are pre-value. Not to say that you've already seen, I mean, if we're looking at the slides, if it's still open.
Yeah, we can still see your slides, yeah.
Good. So you've already seen, since the announcement in 2015, since the announcement of HSBC when they moved their headquarters there in 2016, since we've seen BT have started to move a lot of their headquarters now there, we've already started to see capital appreciation. So in terms of timing, where we are in a cycle, we're already going to see growth up until the point of implementation in 2026, at which point we'd already think that we might be towards the top of a cycle. So we always want to be investing pre-bull run. You know, when you're at the top of the market, when everything's good news about how amazing Birmingham has been for the last 5 years, then you know you might be investing at the top of the cycle.
Yeah, okay, that makes sense. And sticking with HS2, Gary's asked, so train ticket prices in the UK obviously aren't cheap. How likely is it that people will be able to afford HS2 tickets on a regular basis?
Well, the thing that's a misconception about HS2 is that it's going to just tear up the rest of the train lines. There will still be the implementation of normal trains that will be running alongside the HS2. The idea when I looked at actually the design of HS2 was they thought about revolutionizing the actual train line, about bringing in another train. But the idea was that when you have these smaller trains that are already clogging up the system, that there's simply too many people already on these trains, which is driving up the price. I think having an alternative option, having a secondary option, there's no doubt about it that the HS2 will have higher prices than what is already being seen on Virgin Atlantic trains that take you from Birmingham to London. But what it will do is it will alleviate the pressures that are already in the infrastructure. If you look at when that train line was built from London to Birmingham, it was in like the 1940s after World War II. Now that's an existing train line that's been facilitating services to and from London for over 50 years. And we're looking at a train line that's always delayed, is never on time, is overcrowded, and is incredibly expensive at the moment because it is so overcrowded, because it is so out of date. So I think implementing a new train, which will be far more frequent, which will be twice as quick, will offer a huge alternative for people because, not only that, it's a 49-minute journey.
Yeah.
And I think if you've got people shuttling back and forth from both cities, I don't think they're going to be ridiculous pricings, but for certain they will be, more expensive than what you can currently pay. But what it will do is alleviate the pressures on the existing train line, which will hopefully, create some more value on those existing trains as well.
Yeah. So you think it should certainly stay reasonable?
Definitely.
Yeah. Okay. So Sarah's asked, with industries moving outside London, does this mean prices will rise in these cities? Ultimately, will the minimum investment amount in pounds become higher?
Yeah, I think naturally, as price per square foot and the price per square meter, sorry, for those who work in that, as we start to see values increase, the minimum that you're going to be needing is going to increase. I mean, like you say, as Devere, you look at lots of different capital markets, and we do as well. And there aren't many places in the UK that you can invest from as little as £40,000 to be in a city centre in a Western democracy, which has got a population of a million people and home to some of the biggest industries anywhere in the world. And, for sure, as the price per square foot and the price of the apartment keeps getting larger, it's going to be more and more difficult for people to access the ladder. What is so brilliant about these cities is we're not saying £50,000 is a small amount of money, but it certainly opens it up to a much larger breadth of investor who could potentially have that saved. So, yeah, definitely right in thinking. I mean, just from this ladder alone, if you look at investing in Birmingham in 2015, you would have needed a 30% deposit on 144 relative to a 30% deposit on 190 in the space of 4 years. So yeah, I mean, if you look at all the trackers moving forward, we're looking at about 18, 19% over a 4 or 5 year period in Birmingham, 24% up in the Northwest. And that capital appreciation singularly means that it's going to become more and more expensive as we see these things come into fruition.
Yeah, of course. So then after, obviously, we're positive on Birmingham, positive on Manchester. Benjamin's asked, after those two cities, what other ones do you have your eye on? Or even doesn't even have to be cities, I guess.
Yeah, no, cities, towns. I mean, we're quite big on commuter belt as well. We like anything on the outskirts of Manchester and Birmingham. One thing to note, there are more people in this world with less money than with. So a city centre apartment in Birmingham will rent at £900 a month. We like little places like Moseley, just outside the city centre, which will rent at 700, 750, 10, 15 minutes into the city centre. We also like recipients of the HS2 a little bit further afield, but what we're looking for is economic catalysts. How are people going to be employed? Like, without beating the drum too hard, we're always looking for that knowledge economy. We're always looking for who is going to be the major employer in that city. So we like Liverpool, we like Leeds. Leeds is now home to Channel 4, PwC, a lot of accountancy firms. We like cities like Preston, which is actually the last port of call for the HS2. So Preston is a city that we're looking at very diligently at the moment up in the Northwest. Third largest economy behind Manchester and Liverpool. One of the largest employers of the NHS, British Aerospace Engineering. Lots of different pop-up cities like in the Northwest, which will be supplemental to Manchester as it becomes more and more expensive.
Yeah, excellent. I was hoping you were going to mention Salford, having recently invested there. But
I mean,
in general, yeah.
Yeah, I mean, Salford is still Manchester, right? It's in the immediacy of Manchester.
Perfect. Right, going a bit broader then. So, looking at the UK, what do you think would happen to the property markets, or how will the property prices if we had a hard Brexit?
Well, I mean, what is the major stipulant of real estate prices, right? It's supply and demand. It's not like overnight coming out of the EU is going to drastically change the population of you know, what we are at 67 million, looking like we're going to eclipse 70 million in the next 5 years. You singularly have to look at who our house builders are and what is the major problem. So the major problem is singularly that we're a small island. We're a mainly green belt island. There's only a finite amount of land, and a large amount of land is being sat on by 5 or 6 of the largest real estate builders in the world. And whilst we can't build property, real estate prices will continue to increase. Now, just look at where we were last year. You know, the UK should have been the most unattractive place to invest anywhere in the world, with one leader being axed. We couldn't get anything through Parliament. The whole thing was a joke for the rest of the world. But little do they know that the UK was actually the most popular place for foreign direct investment in 2019 in the whole of Europe. Now, while the pound is low, assets are a really, really attractive, you know, an attractive asset class. We know that, you know, I'm living in Hong Kong, that 3 or 4 of the largest consortiums bought the walkie-talkie at 1.2 trillion. The Gherkin in London, 1.4 billion. It's recognizing value whilst taking advantage of low sterling. But this is the basic fundamental, right? We're looking at supply and demand. We're not looking like the UK overnight is going to be cut in half in terms of its population.
Yeah, for sure. Actually, Frank, just want to make that slide bigger for us.
Yes.
So we can see it, yeah, full screen. I know some people will be watching on their mobiles.
Right, okay.
Yeah, no problem. So more about sort of logistics stuff, and actually an interesting question that comes in. So any news on the potential stamp duty for non-residential buyers in 2020? I guess that's probably targeted towards changes.
Yes, I mean, this is pretty interesting what's happening in the UK at the moment with Shahid Javid obviously not having his place. But when the Conservatives came into power at the back end of last year, one of the cornerstone pledges was they want to increase stamp duty on anybody domiciled out of the UK. So for those unfamiliar with how the UK works, if you are a second-time buyer or, you know, an international investor, you will pay 3% stamp duty up to £125,000. You'll pay 5% or the increase of 3 to 5% from 125 to 250. And then it basically goes up exponentially like that. Once you start buying up to 500 to 750 is 8%. So that was brought in by George Osborne in 2016. But one of the cornerstone manifesto pledges was that they wanted to double, or wanted to put 3% on every levy for individuals who are based overseas. So instead of buying a £125,000 property and paying 3%, you'd pay 6%. If you're buying a £250,000 stamp property, where the stamp duty works out at 3.9%, you'd be paying 6.9%. And what this will do is basically, when it's implemented, or it's forecasted to be implemented in the next budget announcement, which is actually end of March, start of April, is it will kill the central London market. It will kill domestic, and it will kill foreign buyers looking at buying £1.5 million properties in Knightsbridge, because they'll be paying 11% stamp duty. Now, an average value of £200,000, paying 3% to stamp duty at the moment, or blended about 3.8, it's about £6,000 to £8,000. Now that is palatable to a certain degree when you're paying it on completion. When you're paying 6% stamp duty, you're doubling your implication from 6 to 8,000 to 12 to 16,000. Now that is a lot. It is effectively double, but it is still palatable relative to having to pay 80 to 100 to 150,000 pounds that you're buying in prime London. So what we're doing is we're trying to get people exchanged. So that means that you exchange on contracts on a certain percentage of the property value. So say with Apex Lofts, for example, if you bought the property and you exchanged prior to the implementation of the increase in stamp duty levies, you've actually exchanged on the contracts that stipulate that you'll be paying the lower stamp duty now. So it's a great way of saving yourself a potentially double stamp duty implication by just being decisive. You know, at the screen that we're in at the moment, you know, where we ran the seminar in August, and we had some seasoned investors who bought when the currency was low, because we told them about, you know, as soon as there's a little bit of confidence, we'll see a rebound in the sterling. And we told them the story that if you bought a property the day before Brexit relative to the day after Brexit, you'd have saved yourself $50,000 in currency alone. So just by being first movers, whether it's the currency, whether it's stamp duty, tax implications, we're trying to do this to essentially try and save people money in the long run. And we're pretty good at getting people exchanged at the moment in short periods of time. So if there are people interested, today's date is the 26th of February. We're looking to try and get people exchanged in as low as 2 weeks. Yeah. Now that's a lot of manpower on our side, but we're basically dedicating a lot of sales progression to get people exchanged to save themselves that potential stamp duty increase should that come in May.
Yeah, no, absolutely. That's good to hear, because it's important to plan for these kind of things, isn't it? I know we've had a lot of questions come in, and thank you so much for everyone who's been sending them in. If we don't have time to ask them during this webinar, we will put them to Frank and get them sent out to everybody the next couple of days, so you will get the answers to those questions. But let me just ask you one on lettings and management. So what are the options on these kind of properties? Is it long lets only, or is there also options for short-term things, Airbnb, things like that?
Yep. So it depends on the contract in which it's written. We, like you say, we're fairly open in how we do work them. So one of our best investments that we launched with you guys last year was something called the Interchange. That was a project built just out by the airport in Birmingham, near the NEC Arena. Now we have that on a short-term service accommodation model, which is basically ferrying in and out cabin crew, pilots, and anybody who wants to work on the NEC Arena. And we're averaging about a 9.5% yield in the downturn in terms of where we are in the season, not in the downturn in terms of economics. So we do have options where we can Airbnb. Of course, it's a discussion for us to have with the developer. For projects that we're underwriting ourselves, like Apex, then yes, we can Airbnb it. And that's certainly an option for us. On the other hand, some people prefer not to Airbnb it. Naturally, when you have a higher turnover of clientele, you have a higher yield, but your kind of exposure to have to potentially fix things is higher. Some people don't like the headache of that. So we would typically have a tenant in on a year-long contract, 6 months to a year normally, but we do have the option of service accommodation model as well.
Excellent. Thank you so much for that, Frank. That's really clear. So we will end it there. So what I'll say, that is loads of information for people to process, and I'm sure people have got a lot more questions about plenty of details. So remember that Devere advised both on, as Frank's alluded to quite a few times, we worked with Frank and API plenty of times on these kind of properties, but we also look around the UK and around the world for various different properties. So if you are interested just to know a bit more, or other details, other questions, there will be a questionnaire that you'll be directed to straight after the seminar. So please complete that, and that will allow you to get some more information. Or alternatively, reach out to the advisor that invited you to this webinar and ask any questions that you have. And with that, I would like to say finally, thank you so much for your donations to the health workers in Wuhan. We will continue to run the series of these webinars, the next one being next week, and you'll hear the information about that one very soon. Thank you all, and good evening.